I now recognize the gentleman from Kentucky, Mr. Barr, for 5 minutes.
Thank you, Mr. Chairman. Professor Girding, in your testimony, you identify CLOs as, quote, close cousins of mortgage-related CDOs that were at the heart of the global financial crisis. From 1993 to 2018, do you know how many principal impairments were recorded for the 9,181 tranches issued by U.S. CLOs over those 26 years?
I don't have that data.
Well, I can tell you what the answer is. It's 53. 53 impairments out of 9,181, or 0.58%, and that includes defaults during the period of the worst financial crisis since the Great Depression. Mr. Vasicich, you have attempted to conflate CLOs with other very different asset classes that were actually at the heart of the 2008 financial crisis, namely subprime residential mortgage-backed securities, credit default swaps, and other squared structures like CDOs, collateralized debt obligations. Do you know how many AAA or AA rated CLO tranches have defaulted over the last 26 years?
I don't have that data.
The answer is zero.
Yeah.
Zero. Not a single default, including during the worst financial crisis since the Great Depression. And the reason why CLO debt securities have performed so well, and by the way, you're concerned about bank investment in CLOs, they only invest in AAA and AA tranches. The reason why CLO debt securities have performed so well historically, even in times of economic distress, is very simple. CLOs bear absolutely no resemblance to the toxic CDOs that preceded the financial crisis. In fact, CLOs performed very well during the crisis, and this is because CLOs are straightforward, long-only investment funds professionally managed by SEC-registered investment advisors that typically hold 90% of their assets in senior secured commercial and industrial loans. These are not residential mortgage-backed securities, subprime, no-doc loans. These are first lien senior secured industrial and commercial loans that in well-known American companies with high levels of collateral. Mr. Nini, can you discuss the diversification of CLOs and the alignment of interest between CLO managers and CLO investors that differentiate CLOs from CDOs?
Sure. The leveraged loan market spans a wide set of firms across many, many different industries and locations. This provides lots of ability for CLOs to invest in a very broadly diversified set of loans, and they all do. They all have rules that require them to do so, and they hold very well diversified portfolios. The managers of the CLOs who are charged with selecting those loans have compensation which looks very much like an equity exposure in the CLO. This puts them on the hook for risk if things go bad. Their compensation falls. The obvious intention of this is to give them incentive to do a good job.
Right. In fact, CLOs are actively managed, and there is a perfect alignment of interest between the CLO manager and the CLO investors because the CLO manager is paid only after the note holders are paid. Finally, let me just make this point. And by the way, there is diversification. Typically, no more than 3% of their portfolios in the loans are in any single borrower and no more than 15% in any single industry sector. That is fundamentally different than mortgage-backed securities where there was no visibility, number one. But number two, they were all concentrated in a single residential real estate market. Finally, this is an important point. Because CLOs are long-run, non-mark-to-market investors, they are term structures, and that means they represent locked-up money that can withstand and, in fact, provide liquidity in stress market environments. So in a downturn, CLOs actually stabilize the market by acting as a buyer when the rest of the market is looking to sell. It is problematic that nobody understands this, it seems, in this room, except for Mr. Nini. CLOs are long-term capital. They're not subject to short-term redemptions or outflows. And in this regard, CLOs provide a vital source of liquidity in a downturn. This is exactly the kind of structure that policymakers should want. So I don't get it. These are high-performing. They are liquidity providers in a downturn. They represent locked-up, the long-term, non-mark-to-market investors. And why does this matter? Because 72% of all American companies are non-investment grade. Leveraged loans provide $1.7 trillion in financing to American companies, and most of the commercial credit in the market comes from non-banks. Because Dodd-Frank era regulation is limiting the amount of leveraged loans a bank can take on, the capacity of non-banks to fill the liquidity gap becomes that much more important. If non-bank lenders become constrained, then guess what? Funding costs will go up. Funding costs go up, bankruptcies happen. If bankruptcies happened, there are less jobs, there are lower wages. That is not good for financial stability. The over-regulation of CLOs would be an impediment to financial stability. And my time has expired. I've got more questions, but my time has expired, and I yield back.